So again, I welcome you all in the second part of this ratio analysis series. In this particular video, we are going to discuss about the capital structure or the leverage ratios. The previous part, we have discussed about the ratio analysis, what are its utility, and we have focused on the liquidity ratios, and under which we have discussed about the current ratio as well as the liquidity or the quick ratio. So let us see what is capital structure or the leverage ratio is. So this ratio indicates the long-term solvency of a firm and indicates the ability of the firm to meet its long-term commitment with respect to the first one, payment of repayment of principal on maturity or in predetermined installment at the due dates, and the second one is periodic payment of interest during the period of loan. That means the first one that we have discussed in the first part, that is our liquidity ratio. In that liquidity ratio, we have discussed about how the company is dealing with its short-term commitment, while in the capital structure or the leverage ratio, this ratio will be focusing on the long-term solvency position of the firm. That means it includes the repayment of principal, maturity of predetermined installment at the due dates, and the periodic payment of the interest during the period of loan. Okay. So let us see what are the ratios that we are going to discuss under the capital structure or the leverage ratio. These are debt equity ratio, proprietary ratio, debt to total capital ratio, interest coverage ratio, and debt service coverage ratio. So let us see one by one. The first one is debt equity ratio. So this ratio indicates the relative proportion of debt and equity in financing the assets of a firm. Okay, it is calculated by dividing the long-term debt by the shareholders fund. So that comes up to debt equity ratio is equals to long-term debt divided by the shareholders fund. We will discuss all these things, what is long-term debt, what is shareholders fund, but let us first complete this slide. So generally, financial institutions favor the ratio of 2:1. That means the benchmark for debt equity ratio is 2:1. However, this standard should be applied having regards to the size and the type as well as the nature of business and the degree of risk. That means though there is a standard that says that if the ratio is 2:1, then it is good, but still if the nature still it depends upon the nature, type, and the size of the business, as well as how much the degree of risk is involved in the particular firm or business. Okay, so let us understand. So the formula is long-term debt divided by shareholders fund. So let us discuss what are the items that include in long-term fund, and what do you mean? What does it mean by shareholders fund? Okay, so long-term funds are the long-term loans, whether it is secured or unsecured. That includes the debenture, bond, and loans from the financial institution or banks, etc. Right. So that basically means our in our balance sheet, the debentures, bonds, and the long-term loans that are shown, that includes in the long-term fund, whether it is secured or unsecured. Okay. Now coming up to the shareholders fund. This is a very important concept in ratio analysis. What is shareholders fund? Now, firstly, there are the 2 or 3 names of the shareholders fund. The first name is shareholder funds, the another name is proprietary fund, and also we use sometimes net worth to calculate to understand the shareholders fund. This all 3 terms, shareholders fund, net worth, and the proprietary fund, is same. Okay, so let us see what is written here. Shareholders fund are equity shareholders capital plus preference share capital plus reserve and surplus minus fictitious asset. So what is fictitious asset? Examples are preliminary expenses, past accumulated losses, and discount on issue of shares. I hope you guys are all aware of what is fictitious asset. So if someone will say, how do we calculate the shareholders fund? That means we need to add 3 things. These 3 things are: first one is equity share capital, the second thing is preference share capital, and the third thing is reserve and surplus of the company. And we need to deduct one thing, that is fictitious asset. Let's say the company has a equity share capital of rupees 2 lakh, while the preference share capital is 1 lakh, and reserve and surplus is 50,000. So 2 lakh plus 1 lakh of preference, that is 3 lakh, and reserve and surplus of 50,000. that comes up to 3,50,000. While there is a preliminary expenses of 20,000. That means that is a fictitious asset. So we will deduct that 20,000 from our total of 3,50,000. So that comes up to 3,30,000. That is our shareholders fund or net worth or the proprietary fund. Okay, I hope it is clear, because that that shows what is the value of the company for the equity and preference shareholders. So shareholder fund simply means equity shareholders fund plus preference shareholders fund, right? So equity shareholder funds means equity share capital plus reserve and surplus, because as we know, the reserve and surplus are reserved for the equity shareholders, not for the preference shareholders, because the equity shareholders are the real owner of the company, right? So I hope this is clear. So coming up, proprietary ratio. So again, I have earlier I have told you what is proprietor's fund. So this we are going to use in this formula. So this ratio indicates the general financial strength of the firm and the long-term solvency of the firm, right? General financial strength and the long-term solvency of the firm. This is a very important ratio to calculate the long-term solvency position of a firm. So this ratio is calculated by dividing the proprietary's fund by total fund. Okay. So the formula comes up to proprietary ratio divided by proprietary ratio is equals to proprietary's fund divided by total fund or total asset. Okay. So as a rough guide, a 65 to 75% of proprietary ratio is advisable. That means if the proprietary ratio is 65% to 75%, that means the company is performing well. That means under the total funds available for the company or the firm, that means if the 65% or the 75% is held by the proprietors of the company, that means equity shareholders, preference shareholders, and that is for the reserve and surplus, then that means the company is performing well. Okay, so let us earlier we have discussed what is proprietary fund. So again, this is just similar as we have explained in the shareholders fund. Earlier I have told you that proprietary fund, shareholders fund, and net worth are the similar things, while the total funds means all the fixed assets including the current assets. Alternatively, it can be calculated as proprietary fund plus long-term fund plus current liability. So don't choose that way. All the fixed assets and current assets, just add all those things, that comes up to your total fund. Okay, so it is very easy. The proprietary ratio is equals to proprietary fund, the proprietary fund divided by total fund. Okay, now coming up to the debt to total capital ratio. Okay, so in this ratio, the outsider liability are related to the total capitalization of the firm. It indicates what proportion of the permanent capital of the firm is in the form of long-term debt. Okay, so it comes up to the debt to total capital ratio is equals to long-term debt divided by shareholders fund plus long-term debt. Okay, we know what is long-term debt. That means debentures are long-term loans and bonds, right? While the shareholders fund, we have discussed it, and the long-term debt is long-term debt. So conventionally, a ratio of 2:3 is considered satisfactory. That means if a company has a ratio of 2:3 in debt to total capitalization, that means it is satisfactory for the company. That means if the company uh, that means if the company is barely depending of 2/3 on its debt, then it is good for the company. So let us as we have discussed what is the long-term debt and the shareholders fund, so no explanation is needed here. Directly we will come up to the interest coverage ratio. So this ratio measures the debt servicing capacity of a firm insofar as the fixed interest on the long-term loan is concerned. Okay, and it shows how many times the interest charge are covered by EBIT. I hope you know what is EBIT, earning before interest and tax, out of which they will be paid. So in the simple sense, it means that how the company is efficiently paying it interest on the loan that they have taken. Okay, So interest coverage ratio is equals to EBIT, that is earning before interest and tax divided by interest. A ratio of 6 to 7 times is considered satisfactory. That means if a company has a interest coverage ratio of 6 or 7 times, that means the company is performing well. Okay, so higher the ratio, the greater the ability of the firm to pay the interest out of its profit. That means, as we know, we pay our profit, we pay our interest from the profit that we have generated in the particular financial year. That's why we have we deduct the interest in our profit and loss account. If you can remember this, then you can have a clear idea that after deducting all the indirect tax, all the indirect expenses, we also deduct the interest, and then after we deduct the taxes from our gross profit to get our net profit. Okay, so higher the ratio, greater the ability of the firm to pay the interest out of its profit. But too higher a ratio may imply less use of the debt or very efficient operation. That means if your interest coverage ratio is too high, that means if it comes up to 15 or 20 times, that means you are not using your debt, right? You are not using your debt, so that if you are not using your debt, then it is a burden on the equity shareholders. So a higher ratio will imply that you are lesser using your debt. Okay, coming up to debt service coverage ratio. So this is a more comprehensive measure to the compute the debt servicing capacity of a firm, and it shows how many times the total debt service obligation consisting of interest and repayment of principal in installment are covered by your total operating fund after payment of taxes. The previous one we have calculated earning before interest and tax, that is EBIT, but this debt and service coverage ratio will focus on after payment of tax. Okay, so the formula is debt service coverage ratio is equals to EAT, that we know, earning after tax plus interest plus depreciation plus other non-cash item. That means we will do the back calculation. After payment of tax, we get our earning after tax, and then after we will include the interest and depreciation we will include. As we know, the depreciation is a non-cash item, so we have to include our depreciation back and plus all the non-cash expenses, right? And that is divided by the interest plus principal installment, right? What is the principal of installment that you have paid? So EAT is earning after tax, and generally the financial institutions consider 2:1 as a satisfactory ratio. And now if you will ask why the ratio is 2:1, so as we have deducted the tax from it to calculate the debt service coverage ratio, so if the ratio is 2:1, then it is satisfactory for the company. That means company is performing well enough. Okay, so I hope this is clear for you all, that we have discussed the first one, our debt to equity ratio, then we have discussed proprietary ratio, then we have discussed the long debt to capital ratio, then interest coverage ratio and debt service coverage ratio. I hope it is clear to you all, and that is all for this particular video, and later on in the upcoming parts we will cover the rest of the ratios. Okay, thank you so much, keep watching it. Bye bye, thank you.